Good afternoon, everybody.
Afternoon.
Good afternoon, everyone. Thank you. Thank you very much for your time. Thank you very much for being present here today. I'm very excited to kick off today's session, which promises to be very, very engaging, very powerful, and also something that we can all go home with at the end of today. And just like, the previous speaker before me announced, when we look at Africa, right, we can definitely confirm that the equity funding is tightening up, valuations are correcting, VC activity across Africa is slowing down. And yet, the need for growth capital has never been greater. So the purpose of this session is basically built around the fact that a lot of founders, a lot of institutions, a lot of investors, they are disturbed by this tension. And that is, how can we rethink financing innovation in Africa? And that is why we have this wonderful panels, with us today to help us break down some of the most complex ideas around financing innovation. I employ every single one of you to sit back, to listen, and enjoy this wonderful session we intend to have together. Thank you. So, to kick off, right, I'm just going to throw a general question, and feel free to jump in. And that is the fact that we know that, revenue-based and hybrid financing, they are set to align with investor returns. They are set to align investor returns with company performance. But how well do these models actually fit African startups, especially those that have irregular cash flows or long-term sales cycles?
I think one of the models that especially works for Africa tech companies is integrating through APIs or whatever, a system that can collect, like you said, revenue-based financing. So whether that's usage of Uber rides with car financing, whether that's how many times a diagnostic system is used. I think a lot of these platforms that actually can integrate into hard assets and actually track the usage over time. That's how I think you capture the longer term growth potential while at the same time closing the risk gap between what could go wrong over time as well.
Thank you very much for that answer. So, Samuel, my first question to you is this. You spent so many years structuring complex, debt deals for corporates and even governments, right? How does that experience, translate when you're backing startups? With all of the uncertainty, and maybe the limited track record, how exactly do you approach doing that?
No, sure, and thank you very much for that. I think, interestingly enough, we'll say that the traditional industries, because they've done this for much longer, are perhaps easier to work with. They have the requisite structures, they keep their accounts in a specific way. They have governance structures that have evolved with the markets as they decide to. And when we work with startups, it's so much harder, I've got to say. Some of it is experience, and that experience grows with time. We find that fintechs typically get it quicker, especially those that have a working capital need, because that needs to be structured because that's part of their business model. But what we are starting to find across the continent is that the pools of capital are starting to form in very material ways, whether it's the pension funds in Nigeria, asset managers, even private funds that have essentially come into place from a debt standpoint. And I think VCs and Ps continue to do what they're doing. There are still specific requirements dependent on the amount of capital you're trying to raise. So if at all you're trying to raise a couple $1 million, sometimes a friends and family round with trustees and some clauses like negative pledges can perhaps suffice. But again, we are talking about scale, and I think we're talking about prosperity, which basically points to size. And it means that the path that has been laid and threaded by the larger institutions is what you need to do. And to do that, you need your accounts to be in place. It's not just a vision, it's not an equity story. Debt is debt, it's very, very granular, it's very scientific. I give you money, you pay me back my money with my interest.
Yeah.
It's not very hard. And you do need ratings, which means there's a vigor that comes from engaging the rating agencies. And there are domestic ones that understand our nuances, and there's a difference between international ratings and domestic ratings. For example, if at all the pension funds were to give you money, you need to have investment grade ratings, and not even just base investment grade ratings, proper ratings. And there are certain entities already that can do that. And so from our experience, if we were to use real examples, working with names like Fair Money, where we started off by raising 1 billion, 2 billion in private markets, working with them as ratings advisor and getting them ratings from 2 of the domestic entities, going to the commercial paper markets and requiring a bank guarantee to do it first before going essentially without any rollers behind their wheels, is a journey that took 3-4 years. And you also have to have that timeline in dealing. Now, dependent on the type of business you have, like I say, for fintechs, it's much easier. You understand the model, you understand whether they're making money or losing money, you start small and then you scale up. For the other style entities, I think it's perhaps harder, but there are others that are trying to do that, even if it's at smaller sizes. And then what builds after you've done that over time? It's track record. I think I'll pause here.
Thank you very much. I'm just going to throw a follow-up to Jubril, right? So at Ion Capital, I'm sure you guys also back a lot of startups. You work with them. How exactly do you manage the risks that are associated with some of the limitations that Samuel has just pointed out?
That's a very interesting question, and it's a good one. Because at Ion Capital, we work not just with startups, but we work with even medium-sized companies.
Yeah.
We've worked on transactions, even for the Sovereign last year, raising over $900 million in their first ever domestic dollar bond. So we have the experience of working from one end of the spectrum to the other. And I see quite a few investee companies here who are our clients, so want to say thank you first for your trust. Getting some of those risks, I think Samuel touched on, include the risk of governance. And sometimes it's not a case of these clients don't want to do right or don't know how to do right. It's they need the support to be able to do right. They also need the patience and the time to get there in the end, right? And we all chase best practice, but sometimes it's what's best for now, right? As you journey towards best practice. So having investors and partners who understand that. One critical thing I would suggest, and this is not just to startups, it's also to those who back the startups, is do not underestimate the value of having a competent financial advisor supporting them, because the last panel touched on exits. And I like the fact that you think about exits from day one. You start preparing for that journey on day one. And usually having a competent advisor, financial advisor, legal advisor, tax advisor, accountant, having those kind of advisors on your side that can help you through the journey is very important. So I touched on governance. There are other factors when you say startups. FX is a big factor.
Yeah.
And it's the big elephant in the room that we try not to talk about, but I'm here, so I will. Let's put it this way. What year are we now? 5 years ago, in 2020, using Nigeria as an example, the FX rate was the official FX rate was about $360, $360 naira to a dollar.
Yeah.
Today it's circa 1,440.
Yeah.
5 years later, right? What does that mean for the local startup and the SME or the medium-sized business? It means they need to run 4 times as fast to remain on the same spot, right? Not that the business is bad or the fundamentals are bad. It's just because they're receiving US dollar and they're operating in local currency. It's almost, the deck is stacked against them. So one of the risks that we help our clients work through is FX. right? Especially if they're receiving US dollars or hard currency and there's a currency mismatch. So there are a lot of other risks, but I would say, please, please, please get competent advisors who can work with you as early as possible and understand the journey that you're on. And it's not just financial advisors like Samuel and I, it's also legal advisors, tax advisors, even transfer pricing at some point comes into play, but very important.
Thank you very much for that. Lexi, I'm just going to do a follow-up to that. So we've sort of highlighted some of the issues alongside the risks, but then how exactly would you say venture capital, venture debt, and private credit, how exactly can they all work together to actually help support the startups to the institutional stage?
Yeah. I mean, I would say part of the problem is the debt financiers themselves, no offense. But a lot of our companies have very low risk working capital requirements. I mean, whether that's float, which is a huge problem with cross-border companies, payment companies, because they're usually, to meet the needs of their customer base, required to pre-fund accounts locally to make sure those transactions happen instantly. Another case, it's actually secured credit against an asset. So generally the risk is quite low, but there's been, especially for African institutions, there's been such a history of financing traditional commercial enterprises where they can, manufacturing companies where they can touch the inventory, see it, feel it. So I think that there's a huge amount of education that still needs to happen from fintech companies to the debt financiers themselves, especially when it comes to local debt. I mean, I think there's several development finance institutions in the room who've been quite creative about creating products that are actually suited more towards these more digital sectors to provide affordable working capital. Because I think that the problem that a lot of companies here face is, yeah, they can go get venture debt from international platforms, but they are getting hit so much on the Africa risk story that it often, there's the currency risk, and then of course there's high interest rates, and that becomes quite detrimental to them.
Yeah.
So maybe to try to come back to your question, I mean, what we do is we do try to educate a lot. We have a lot of friendly debt partners that we will share our companies with, try to tell them the story, introduce both parties, try to get them over the line, act as a trust agent, saying, look, this is a company that we have known for a long time. We are helping implement these governance standards as was explained, is so important, and bridge that gap between the two of them. It still takes a lot of time, I think, to get traditional institutions over the line. We're working with some of our LPs as well to do that in some cases.
Yeah. Thank you very much. And for you, Meissa, right? I mean, I just want you to state explicitly, what is the IFC's role in helping both startups and SMEs grow from, the new ones phase to actually getting to become institutions in the future? How exactly does the IFC come in, right? I would like for you to give us maybe a case study just to have a better idea on what people can actually look up to.
How much time do we have?
What he's saying is it's very slow.
Ouch. Listen, I think you cannot answer that question without defining what the role of the IFC is. And the role of the IFC is a mission. It's shared prosperity. So because we believe that shared prosperity is only achieved through job creation that can help alleviate people from whatever status they are right now, what we do is we design a number of strategies and tools around that mission. And when it comes to investments in Africa particularly, and as you touched on, SMEs and companies, I think where we have the most to play a role in is not just to dash money out. So what we can share, one, is best practices. And best practices are I think it's not a common term, because what's a best practice somewhere may not be adaptable to this region here.
True.
But it is an example of something that has worked. So when we come to Africa and we look at investing, when we talk to companies, to SMEs, the message we want to cut across is, look at what was done over there that we know about, but let's try to find a way to adapt it to our continent and to our own traditions and cultures and way of doing things. And concretely, how does it materialize? Well, advisory, as you said, helping companies and people bridge the gap. So it's a range of tools, blended finance, that we can put together and tell these companies, well, it's not just about giving you money and telling you, go figure it out, right? We do a lot of technical assistance, we do a lot of market creation. And that is a dual process. It's not just, I would say, a responsibility for IFC or any DFIs actually. It is a shared responsibility, because it's a journey where you go with a company, a founder, an SME, a fund, whoever you're working with, and you listen to their perspective and you bring yours and you work together on a way to achieve it. And if you're talking about a concrete example, one of them that I may provide high level is a very innovative company in which we invested a couple of years ago. When we invested in this company, they had $0 in revenue. Nobody's surprised?
No, I'm very surprised.
You're surprised, yes. Because you would think the image of IFC is that you have to come into these very mature companies, stable, and do plain vanilla. It's not always the case. So what I was saying is, to cut it short, what the IFC did in this specific situation is we challenged ourselves to say, what role can we play in this specific situation instead of always fitting in a box? So we made the investment, we took the risk, and we put every single options at the company's disposal to help them bridge the gap that they may have had as an early stage startup. And 2 years later, this company is doing phenomenally well. So we're happy to be able to, yes, have a mature position in the ecosystem because the ecosystem still needs it, but also be able to play across the verticals and the stage. And we have a bunch of tools that we have at our disposal to be able to help the ecosystem.
Permit me to ask though, is this startup a fintech startup by any chance?
No.
Wow, interesting.
I should have mentioned that.
I asked because while Samuel was speaking, he mentioned something about fintech having the fastest route, right, compared to all the other segments. And I just want to touch on that very quickly. Why do you think fintech has the quote unquote the easiest route to becoming like an institutional organization compared to all the other segments? And what exactly would you say is the future of venture debt, venture capital, especially for sustainable focused startups in Africa?
I think the sustainability of any business, tech or non-tech enabled, is essentially its unit economics. And if it's positive, and it's positive and predictable, then you start to go into the world of debt, because debt needs predictability and stability. Why are fintechs perhaps faster? And if you look through the route, whether it's starting with names like Global Accelerex, Fair Money, even InterSwitch, recently I think Piazza has done quite a few, call it commercial papers. It's because they're in the business of money, and the unit economics is the method of payment. And it makes it easier for people to understand, even though sometimes their models are not very understandable. But you can see the plus and you can see the minus and you can see there's plus left. And that plus should be able to pay interest, and you can see where growth is coming from. I think it's just general, and you'll find this even in the broader economy if you look at the stock exchange. Outside of a few very large conglomerates, typically across most markets, even globally, even though the US has a bit of a balance. The financial institutions do come as the premier institutions at first before others decide to show much value and much more growth, accretive. I think you also asked around venture debt and what the future of venture debt is. Again, venture debt has typically been in smaller sizes, and what we are seeing is increasing amount of family offices, asset managers creating private credit funds, including ourselves, to be truthful, that are saying, let's look through this. Of every 100 opportunities that come through, maybe there are 2 or 3 that we can give $500,000, $1 million to, under the right protective framework. And that framework requires time, and it's never simple or never straightforward. But we've seen, at least in the last 2-3 years ago, we saw venture debt firms from SF or other places come to Nigeria and actually make good with it. I think the other argument I always have, and we have this internally quite a bit, is whether safes are equity or not. And we've been in certain restructuring scenarios with some, call it African fintechs, where the safes were safer than everything else. So when you have your liquidity preference of 2-3x, and of course it's super senior, and guess what? Even if you gave the person $1 million, $2 million, the first year of interest was paid up front. So again, it's that $2 million times 2 that you're getting paid if there's a restructuring. And there we've been amazed. They signed the document, so of course they paid out in the event, in this specific event where the business had to sell itself. But to me, that felt very much like debt. Now, there are other instruments that will be senior debt, working capital facilities, which lends itself to the business and the unit economics again. And I think everything is still overarching. It's essentially what we're saying here. Your business needs to be sustainable. Debt is not equity. It's not on a dream. It's not even a vision. It's actual numbers. And growth matters, but that growth is essentially based on your unit economics, or how that unit economics essentially shows itself on paper and not just by verbal assessments.
Thank you very much for that. So Lexi, I just want to bridge the question that I asked him and ask this question. So how exactly can African startups take advantage of the current opportunity that is on ground? When we look at venture debt, when we look at venture capital, let's even look at other startups that are not playing in the fintech space. Mm-hmm. How exactly can they position themselves to maybe become like the next fintechs?
Look, I think maybe one thing that we've seen work, and these are more asset-heavy models, but that they do lend for certain assets off of their own balance sheet, but then they structure these in collateralized debt instruments and off-sell to those to the bank. I think that's an interesting way to get started in this, and then eventually maybe those bank partners will actually plug into you and become debt partners over the long term. I absolutely think that the lendables, the DFIs of the world are great debt partners to try to engage with early, even before you're there, and start asking steps, and maybe Meissa can talk to some of those that would be relevant. I do think probably what's going to come longer term in some African markets is more consumer-backed financing. So consumers wanting to have an earn product, and it being, I think PiggyVest already does this for several of their customers, but it can be anything from owning a share of property to having, a portfolio of maybe consumer credit, or even being able to invest in government bonds in another market. And I think you'll maybe see more of that kind of pick up some steam as well, especially in some more mature markets, with trust and transparency as some of these platforms mature. And yeah, I think all the things around governance and understanding and tracking your data and trying to have real core earnings rather than one-offs is hugely important, and showing that you're there for the long term and your unit economics are sound.
Brilliant. Thank you very much for that. For you, Jubril, this is completely off track, but what role do you think AI can play in terms of raising investor confidence and also creating a balance, between debt and equity financing, especially in Africa? And feel free to jump in if you have comments.
That's a very interesting question. I think on the AI side, I think AI today is what fintech was like 5-7 years ago. There's a FOMO now for not getting into AI.
Yeah.
And AI in itself, is, in my view, is neither a good thing or a bad thing. It just makes whatever you do a lot more efficient. So at the end of the day, if you're running a good business, AI helps accelerate or make it a lot more efficient. If you're running a bad business or you have bad practices or policies or things, it makes it a lot more difficult. We see AI already being deployed in fund management by asset managers, not just in Nigeria or Africa, but all over the world. For startups, it's important. I think the future belongs to AI, at least the immediate future. And this is not just for startups. It's for every business and every entrepreneur here. Every investor here needs to understand what AI can do, and AI itself is evolving. AI today is different from AI of 2 years ago, right? So needing to understand that is very important. But if I may direct the question back to the startups, to the companies themselves, it is incredibly important that each of the, whether it's startups or medium-scale enterprises, even the large ones, have practices around governance, around collaborations in their various ecosystems, whether intra or inter-ecosystems, that ensure that they succeed and they adapt, especially in our market in Africa. And this is the same for most markets, but things go wrong, right? And how we're able to adapt to those situations usually is the difference between who wins and who loses. Give an example. We never expected the speaker to go off today, right? Yeah. But we go on, we move on, we adapt, and we keep things going, right? If the head mic isn't working, use the hand mic. Just an example. Businesses themselves need that kind of support to establish resilience. And to your question about AI, it's important, incredibly important, that not just the startups, but businesses, all entrepreneurs, investors understand the capabilities and, okay, well, I said it, well, the potential of AI to either make their businesses great, a lot more efficient, or to, unfortunately, lose their businesses in the next 4 to 5 years. But there are basic things around businesses and startups that they need at the fundamental levels. They need support, they need technical expertise, they need management expertise, they need access to equity, and equity at the right time. Debt is not equity, as was said. But some of these things are very important. And AI is great, but there are fundamentals that we need to address.
Somebody, you want to jump on that?
See, at the end of it, let's take away from the company's perspective and let's look at it from the debt provider's perspective.
Yeah.
What do you want to know? That your money is being paid. So it's really, I deploy using the parlance, and then it's risk management. And I think that's where perhaps AI comes through.
Yeah.
And I think that's been one of the biggest gaps, even for large banks, smaller entities. If there is a digitally enabled business, how do I ensure that in any random moment, my money returns and the model doesn't break? There's a little kink, and there's a lot of smart tech people. They can essentially take advantage in a very, very short period, and that breaks everything. And AI perhaps provides a solution, but perhaps also the naughty people might be using AI to try and do that. And so that race is going to continue, and it's going to be embedded. But we do see it from a solution standpoint, even though, of course, there has to be always evolving.
And
I wanted to jump back to Lexi's point quickly about ventures that let's be philosophical about it a bit. I personally don't believe that there's an issue in terms of the availability of funding options in Africa. I think what's been available is equity because that's what companies have been optimizing for. So if you talk to companies today, they're talking fundraising, they're talking equity. So they've built their whole models in terms of scale, in terms of company profile, in terms of balance sheet, around how can I attract equity. So even if I am interested in providing venture debt today, if you're not presenting to me a profile that is attractive for venture debt, well, I cannot give it to you. So maybe the question should be that companies and founders should take the time, look at the long-term vision that they have and say, if I am to get there, what are the best sources of financing that would help me get there? And if debt, be it traditional, be it venture, is a serious equation, part of the equation, then optimize for that. There's no secret to that. It's either you have an asset base or you have a cash flow profile that allows me to give you that, right? So as much as I encourage investors, and we have a lot of investors around the room, to be flexible around their thinking, I think a lot of the answer also resides with founders and how they're building their companies to optimize the source of funding that is the right one for them.
And I just want to ask one final question. Sorry.
just a final question from that. So when we talk about private credit in Africa, how can we make it both scalable and attractive, to institutional capital? How exactly can we make that happen?
I mean, Sam just said it. I want to be repaid. Ideally, I want to be repaid. But listen, at the end, we're all in the business of taking risk, calculated risk. So the risk profile of my environment, I will either adapt to it or I will not play in that environment. So if we take the assumption that we or other providers are playing in this environment, they will adapt to the risk profile of the environment. And that ties to my earlier comment. Now, for us to adapt to it, we need a framework. The framework is the company. If I look at you, are you providing me the right set of parameters and comfort to say venture debt is the option that I need to give to you? And I'm happy to see that it's becoming more and more of a conversation and a norm. So I think we're already getting there.
Thank you.
A bit.
Thank you. Thank you very much. But thank you
Thank
very
you so
much for
much.
your time. And thank you, ladies and gentlemen, for listening.
Thank you.